This tutorial looks at the different ways in which you can go about investing in stocks on the stock market. The first way in which you can purchase shares on the stock exchange is if a company, let's call it Company A, issues its shares for the first time. So we call that an initial public offering. Company A issues shares to investors, and investors are then said to buy shares in the primary market. Primary because it's the initial offering of these shares. The second way in which investors can buy shares in a company is to buy from each other. So since the transaction is not between the company and the investors, as was in the first instance, the transaction here is between the investors themselves. We call that the secondary market for purchasing shares. The third way in which an investor can own shares in Company A is indirectly by owning shares of a unit trust. A unit trust is a collective investment scheme. Basically what that means is that an asset manager pools people's funds together and then buys shares in underlying companies. So the investors, as a result of their ownership of a stake in the unit trust, indirectly then own a stake in the companies that the unit trust has bought shares in. This is an indirect purchase of shares. So the three avenues of investing are in the primary market via an IPO, where a company sells shares directly to investors. Then there's a secondary market. A secondary market is where investors buy and sell shares of companies amongst each other. And then lastly, there's an indirect purchase or ownership by investors through their owning of unit trust, which own companies.